Welcome to the Imperial Wealth Podcast, Australia's #1 crypto mining solution provider and leader in training and education, covering the latest news and insights into macroeconomics, cryptocurrency markets, altcoin news, and technical analysis. So now, without further ado, let's hand it over to the Imperial Wealth team.
Hi everyone, welcome back to another Mining Store podcast. Today we have Taylor, Mitch, Theo and myself, Tony. Going to be discussing all things crypto, the overall market conditions and going through a Q&A as well from some of our community members. So firstly, over to you, Taylor. What have you got in store for us today, I guess?
Yeah, so actually we've got two questions today, both from the same member, so I appreciate them flicking them in. Probably one for all of us to sort of have a chat through it and go through. There's two different styles of it. All right, so first one, with the Fed midterms coming up, do we see an opportunity in the market? Then following it, would we see volatility? Only asking due to the Fed pulling out oil from reserve to keep fuel prices down.
Mm-hmm. Yeah.
Okay, so quite a bit to kind of unpack there. And I guess we're going to be getting into some of the opportunities in the market a bit later in the podcast because we do have a couple of charts that we're going to go through. With regards to the oil reserves, there's been a lot of critics of Biden for releasing the oil reserves because he's going to have to fill them up at some point, and that's just a short-term measure going into the elections. We've also seen that there was some pressure from Biden and his party on OPEC to keep up the production until after the midterms, whereas OPEC actually agreed to reduce the oil supply by roughly 2 million barrels per day. So we're probably going to see oil start to creep up depending on the demand side. As we go into a recession, demand generally kind of tapers off. So there's obviously going to be a supply and demand struggle there. But fundamentally speaking, with the war in Ukraine, the oil kind of production reduction now, but with OPEC, and also now with the emptying of the oil reserves, I guess fundamentally speaking, it looks like oil should pick up into the future.
Yeah, and I
think it's an interesting part with that, obviously, with the way in which the midterms will react. You know, that letter came out from the Saudi Arabian royal family, basically pointing the finger at Biden, saying that he asked them to hold off from reducing supply until after the midterms so that he could basically save face.
Yeah.
It's a pretty embarrassing debacle going on.
I think
it doesn't look good for the midterms in terms of for Biden. So it's going to be interesting how that plays out.
Yeah, I think it's a good question because there's two parts of it. There's the kind of macroeconomic oil side and the implications, but there's also this historical context. I shouldn't be quoted on this, but I think midterms historically for kind of markets are quite bullish and quite good. They're like more often the returns throughout midterms more often than not have been good. So I've kind of used that midterm and medium term in tangent with one another when discussing with our subscribers to the Trading Academy how midterm rallies historically, even dating back I think to the 1930s type of deal, have historically been quite bullish and quite good. So there's always that to hold on to no matter what the context is, because obviously the markets historically like to repeat themselves, but that's also something to keep in mind, I think.
I think last podcast as well, we did share a chart showing how October is generally a positive month for the market. So you have a dip into the 7th and then a rally into the end of October. And it looks like the market may be playing that out. So we've got another chart that we'll go through a bit later in the podcast as well to kind of highlight that.
Yeah. All right, awesome. Another one we had is, I guess, in relation to all of the news coming out about MasterCard and all that sort of stuff. Basically, do we see crypto projects working alongside governments being detrimental to crypto and decentralization?
Yeah, so
I can just say I reckon it's happening irrespective of whether people like it or not.
Yeah,
100%.
And I think people should bring. A client actually gave this to me, Regan, which I found fascinating. So if anyone else has seen that ISO 200 and 222, I think it is, .org. It's like a site that shows every government, including Australia, and which blockchains they're working with, like Quant and all of these other. So yeah, unfortunately, we're already working with them, guys.
Yeah, I think if a lot of those members of ours and those part of the Discord, you would have seen like over the last 2 to 3 months, I reckon I would have done at least 6 to 7 articles alone on the Australian government's involvement with the RBA and them seeking to eventually bring out a CBDC, which is a central bank currency. So you've even seen ANZ come out with their stable coins, like they're being used for carbon credits and different transactions. And I think, like Theo said, the question revolves around obviously centralization, which of its purest form is a government agency versus what we're into, which is decentralization. And unfortunately, like Theo said, whether people like it or not, we live under government rule. If you were in China during that mining ban, you couldn't mine. It's just how it happens. And I think we're fortunate in Australia that the industry is really growing at a rate that they're kind of looking to kind of support it through the right legislation and not the wrong legislation. Central bank digital currencies are a bit worrying, but I think the token mapping article I did and other things like that will actually help the industry. And more often than not, I know pure decentralized people, they hate government involvement, but unfortunately for this industry to kind of push forward, it does require some tinkering from the government. Yeah. So, and you need the regulation in place, because if we want all that institutional money, if you want things like MasterCard, if you want Google to be able to offer their cloud services to be paid in crypto, there has to be some form of alignment with, the jurisdictions that these companies are involved in, which is most nations.
Yeah, absolutely. I would say the exact same thing. Is if you want, obviously, the institutional capital to flow through and all of that good stuff. And part of what I was discussing with Regan when he told me about this is you sort of, if you can't beat them, you got to join them to a degree. So like, even though I don't like some of the projects that they're working on, I'm obviously taking a second look at them, probably averaging into a couple of those positions purely based on the fact that the government is actually working with them, and that's it. Not because I necessarily like them or anything like that, but exactly what Mitch has said.
Funnily enough, I mean, you did mention Quant as one that's probably working with the government, and I'm fairly sure they're probably the only top 30 project that's done about 400% in the last 3 months, whilst everything has crashed 80%. So looks like the government might be pumping Quant's bags. So if you want some form of centralized investment, maybe Quant is the one for you to let the government carry your bags for you. But thanks for that, Taylor.
I'll just add on. I was having trouble hearing Theo, but I'll just add on that central bank digital currency. So at the moment, what we're seeing in the forex market, which people aren't aware of, is all currencies are seeing a mass devaluation at the moment against the US dollar. The euro hit 1-to-1 parity. The pound crashed to near 1-to-1 parity to the dollar. So we have kind of 3 major Western currencies now sitting near 1-to-1 parity, which is kind of the introduction where they can now say, here's the central bank digital currency. Yeah. So it's quite concerning that that's happening in the currency market, but it does look like it's kind of leading into that direction.
Yeah. And I mean, I think it's, thinking back on this year, it's probably lucky that there wasn't some form of Australian stablecoin or central bank digital currency that we all parked ourselves in during the bear market, because we would have lost a lot of our value in our holdings if we weren't holding in USDT or a US dollar equivalent stablecoin, so or currency. So that was good.
I think that the first people get to adopt it.
Interesting. Well, let's jump into sort of Theo's miner update.
You could do Theo. That's right, Theo. You go ahead, and then you can go on with your miner update.
I was just going to say that South Korea is building that metaverse, so they're close to already having their token ready for that launch, which is interesting. It's interesting to see how that plays out. I think they'll be one of the first.
Yeah, for sure.
But yeah.
Alrighty, do you want to? We'll get into the mining stuff now.
Yeah, we'll get into the mining. I'm actually wearing my Binance socks today, guys. So.
Great stuff, great energies.
So yeah, I've got a few things to share. Obviously, the big talk and I suppose across the industry is obviously the current this month the network difficulty increase, overall hash rate increase. Obviously, we've seen it climb tremendously in the past year. The overall hash rate has increased about 33%, which is enormous. And the other thing that's sort of not normal thing, but is also the profitability in a bear market. This hash rate's been added at this time, and for the most part, it is most of these XPs coming online, the 140 terahash brand new machines. So I guess we're starting to see them all, find rack space and all these types of things, which is influencing the hash rate and therefore the difficulty. So there's a few things. I guess the unfortunate thing is if you're not, getting a cheap power rate, which fortunately enough, most of our clients are around that sort of the good area to be around is that sort of 9 to 10 cents US price range, and then on top of that, obviously if you're paying cheaper power, it's always going to be a bit better in this environment. And then finally, there's obviously the older equipment, are starting to get phased out. Things like S9s are just simply not feasible to be running in this sort of environment. So, we've had a handful of clients have those sort of older equipment and start to look at these newer equipment, because the good thing is, although that the market is down and the profitability isn't good, that also means that the mining units again are substantially low. We're talking about 70% price differences.
Yeah. And
I think that's really where the opportunity lies. I think most people that have been part of the space can see that and join, still adding to their setup by buying these new equipment, because you're future proofing it for not just past the next halving, but also well into the second half of that next halving as well.
Yeah.
So you don't want to, I guess, get caught out and at the top of the market, which many people, including myself, have bought miners over the last sort of 6 months. I think feeling that, but also averaging, and now also offsets your overall costs as well, your average cost for units.
Yeah.
And then the second thing is there's also a hash rate derivative coming out soon, which should be interesting. I guess it's people are going to be able to sell their hash rate, and I guess it's probably more inclined for institutional capital gain exposure to the space without physically having equipment. So that's going to be interesting to see how that plays out.
And just because me and Theo were speaking at length about this yesterday, and for those that are a little bit confused or might not understand, you can kind of liken it to the Bitcoin ETFs that were brought out that allowed institutions to obviously trade on the volatility and the movement of Bitcoin without actually with mitigating the risk of actually holding the asset and having to have it stored in a wallet and everything else that's attached to it. And I guess it's the same in theory with this hash rate derivative. You don't have to obviously have the risk of holding the hardware, having it installed, blah blah blah,
or the infrastructure costs, or the rest of it. And I think so obviously with the current hash rate, look, it has increased quite a drastic amount. Like there's got to be at some point, some older machines are going to start turning off, and there will be a plateau at some point, because these machines, there has just been a high influx because of all the new equipment being released and installed. So there should be a taper back at some point. We're currently sitting at about 254 exahash. And also, it wasn't one of the, I think it was a couple of days ago or late last week, we recorded one of the lowest cost per terahash days in Bitcoin history, which not the best news. But like I say, I guess it depends on how you look at it. And then again, this is when the factors like energy consumption, power costs, and these types of things have to be at the forefront. And then finally, we've got a couple other things that I found interesting. So a client of mine, Matt Starvis, so he mentioned that Binance is going to be helping the mining industry with lending. So he tried his, because he's obviously got quite a few machines with us, and he wanted to so he sent them a message and sort of told them about his story, how he's got X amount of miners, and they sort of replied to him what the requirements were, which was insane. So you have to be a VIP Binance member, first of all, for them to lend to. And the requirements are 5,000 BNB to start with. So in dollar terms, that's 2.5 $1.25 million in BNB alone. That's just like to have a look in, or 500 petahash of total mining equipment that you've got online. So what they're saying is it's not for us retailers.
Yeah, I don't think there'd be too many clients of yours getting on the VIP list at Binance anytime soon.
I know, but still, nevertheless, still helping the industry. And then finally, just a couple other, I guess, dot points. A few of the public companies are starting to show some, some cracks in their setup with their overall debt and so forth in this current climate. So it could be seen as a good or bad thing with some of the big guys. I guess with them falling off, it does mean lesser competition for people in the space like retailers like us. But yeah, that's virtually all it from me, boys.
Awesome, alrighty. Cheers for that there. That was quite detailed. Really nice to hear that information. Tony, we'll move over to you. Actually, Tony, before we do move across to you, I thought just as I flick over to the market update, for those listeners that have made it through to this part, I'd do just a quick, maybe 1 minute walkthrough of our new platform and our new website so they can see that. I'll quickly So this is our new website for those watching. This is obviously the crypto side. If I take you to the front page now, for those that aren't members with us actively, that have a subscription, say, to betting, crypto, forex, we still do have a free side to the website. And one of our really cool big assets that we've brought out to the new website and platform is the Knowledge Center. So for those that are new to cryptocurrency or want to read on certain topics and learn more, I built this out in the first couple of months of this year, so you can go here and see cryptocurrency wallets, things like wrap tokens, what's a blockchain bridge, you can learn more about Bitcoin, and in each one, it will have the topic, a brief description, and you can see all the related articles here. So I've just used Bitcoin as an example, and then obviously down the line as well, we'll also have a terminology guide and a coin library to be released. I should add as well, there is betting for those stuff here, and there's forex and finance and economics, so you can read plenty of articles there if you want. And then on our crypto side, sorry, let me just get back onto the Trading Academy. Hang on, I'm gonna have to sign out and sign back in. Apologies, everyone. And then on our crypto side, it's pretty much got our entire platform of trades, token analyses, market updates, video updates. We've got our NFT Premier on there, some education, some courses and whatnot. But yeah, really exciting stuff. So yeah. Alrighty, moving on to the update. Tony, did you want to kick things off?
Yeah, sure. So what's happened since our last podcast? We've had some inflationary data from the US, which did actually come in higher than expected. We've also seen the Bank of England step back into the market and protect and start printing money again. So, we're slowly seeing a shift in Western central banks coming back into the market to actually protect the economy. So, I guess everyone is really kind of waiting to hear from the Fed. So we've got the next interest rate meeting at the start of November. They're expecting to raise rates by 0.75%. We're then going to be, I guess, waiting to hear about, the forecast going into 2023 and thereon.
Now, Tony, just to clarify with that, it's now 100% probability of that 0.75 hike rate, right? Yeah. Okay. Cool.
Yeah. Now that may actually be priced into the market already because people know that that's going to take place.
I think
so that's most likely priced in.
I think the main sticking point there, the glaringly obvious thing is that if you watch the market in the hours of the release, it dumped to quickly price it in pretty quickly and recovered fairly nicely. So I think I am leaning with it being priced in.
Yeah, exactly. So if we get that, 0.75% rate hike, we could actually see a sell-off post-Fed meeting because it's priced in, and now investors or traders are anticipating kind of like a reduction in the size of the rate hikes moving forward. Yeah. We've already seen the RBA reduce the size of the interest rate hikes. We've seen the ECB start printing money. We've seen the BOJ stepping into the market. So the Fed is really kind of like what everyone's waiting for before they start moving into a risk-on environment. So, we've spoke about the possibility of a bear market bottom towards the start of 2023 on a number of occasions, which coincides with the Bitcoin halving event and the average Bitcoin market bottom taking place roughly 400 days before a halving, which also coincides with early 2023 as well. So we'll stick to that kind of theory. However, what I kind of want to look at today is the chart of the S&P 500, which we can see in this kind of bear market at the moment. The S&P 500 is moving in like a 40-day cyclical bull and bear market trend. So we're having a 40-day bearish trend, a 40-day bullish trend, and it's kind of continuing from there. Now, at the moment, we're seeing that the S&P 500 may be entering into a 40-day bullish trend, which coincides with last week's podcast where we showed October, which tends to be a positive run for the market, which also coincides with, the midterms and a positive result in the market as well. So, over the next couple of weeks, we may see a little bullish rally, but ultimately it could just be another bear market rally, and we could be heading a bit lower after that as well. So, expecting a bear market rally, and then we have to kind of see where the market wants to head after the Fed interest rate decision early November.
Yeah. I wholeheartedly agree with most stuff that was said there. I do want to just add that with the S&P and kind of these stock markets, they have found some pretty good support at these levels, which is encouraging. And the translation kind of goes to Bitcoin as well, right? So probably 99% of the market have been expecting that low to be retested since June. And I don't know about you guys, but I've been fairly impressed just generally with how Bitcoin has held up since then, and continues to find support. And the S&P is continuing to kind of rally off similar support. So I think it does support the notion that we get at least some form of relief, whether that be a bear market rally or a midterm rally. But the signs are there, which is encouraging.
The main sign is Nancy Pelosi. So the influence Nancy Pelosi's back in. She's exercised 20,000 Google call options. So she's actually stood for delivery on those contracts. And in Elliott wave analysis, we can see a possible bottom formation to form wave A. So that also coincides with another large rally on Google's stock price, or a bear market rally before the next leg down. So Nancy Pelosi generally leads the market anyway.
Yeah. Old Nancy, she's a funny character. I think, sorry, just to add on, because I do want to add on, because it was part of my fundamental update that'll be sent out to members, but I did joke about it to Tony that, the biggest story for kind of institutional corporations in crypto the last week has been Google incorporating crypto payments for their cloud services. And I kind of joked that, Nancy's buying the bottom of Bitcoin and Google essentially. So it's an interesting buy, nevertheless. And sorry, Taylor, did you want to add something?
I'm pretty sure, I just saw it this morning, I didn't get to read into it, but I'm pretty sure the company that she bought shares in for that natural gas bought by BP, $4.2 billion, and I think it went up by like 56% overnight.
Well, she just strategically knows how to invest in natural gas when it's wanted, chips as well, and now Google. So she's a very smart investor, Nancy. She's very, very smart.
She's worth $2 billion supposedly, and her annual salary is around $200K. So that something doesn't add up there.
That's just there to pay the kids' school fees. The rest is there for fun. Alrighty. Thanks for that, Tony. I'll go on to crypto now. We did touch on that, so I did want to say that Google Cloud has announced they'll support crypto payments. That's to do with the partnership with Coinbase. I think there'll be more information will be released, towards the end of this year in 2023. But obviously, it'll presumably accept payments in cryptocurrencies such as Bitcoin, ETH, maybe BTC Cash, Dogecoin, those type of more popular established currencies that are used in the crypto space. And it'll most likely, be done through Coinbase Commerce or Coinbase Prime. So that's a real good movement in the industry, obviously. But we'll move on to some technicals. We'll start with Bitcoin. I'll zoom in this a little bit just so you can read a bit better. But just for immediate price action, if you draw this kind of Fibonacci from the range low to the range high, you'll find that we're finding really good support. I'll get this chart up on a bigger thing here. So we're finding the range support and the 886 of the range 2, which my members to the Trading Academy have seen over and over and over as real strong support. But this support level actually comes obviously from the 2017 ATH as well as the 2020 run-up prior to the pivot there. And we're finding a lot of demand and a lot of buying demand at these levels. You'll find we wick down there quite quick, and it's not as if we're staying there for, you know, a week on end, rebounding into the 19k pretty quickly. You can kind of see this here on the chart. I do want to add that the range point of control is also still holding a support. Like you literally saw this morning, if anyone looked at the market, we were kind of hovering at the golden pocket of this local Fibonacci range before dropping to the point of control, and we literally immediately bounced off it. And I'm pretty sure like a lot of people decided to long off that level given how well it's held as support prior. But moving on, we'll take a look at the range point of control as well. Sorry, just back on that point, I did add in a parallel channel here that you guys might find interesting. You can kind of see the confluence with the middle of the range here and the touching point. So who knows, it could be that we retrace up to this point of confluence as the next touch before heading lower. I wouldn't be surprised if we saw a little rally soon to the 21Ks, given that we've just been ranging for so long and people are getting a bit impatient. But yeah, that could be something to watch out for. I do want to just look at the entirety of the range, because if you get the entirety of this range we've been trading at since June, you'll see a similar range point of control for the entirety of the range. Now, this is interesting because it's slightly different to the smaller range. If I show you here, it's that we kind of aren't holding this as support, but it's failing to break out kind of either side of it, which is showing how hard BTC is kind of struggling in this no man's land at the moment. And you can kind of feel the market sentiment getting a bit impatient and wary of what's next. But I'll look at that a bit later in our more medium to long-term charts, but you can probably expect a move soon, most definitely. I will look at a bit of a longer-term chart here. That's just showing that stronger area of support from those prior levels. But I do want to just discuss MACD. I'm talking about MACD because you can see it's fairly neutral here, which obviously indicates that we're due for kind of still some more choppy sideways price action. But I think the good thing about showing BTC holding the strong level of support for now, you know, what has it been, 4 months, 5 months, is that RSI kind of since the start of September has just been holding a strong uptrend line of support. And you can kind of expect, like, if we continue to hold that RSI uptrend, it's unlikely that we break down to the downside. It could be that we just do remain a bit choppy or that we head upwards. But that's just, yeah, another point of confluence that provides us with some good idea that we're probably most likely going to hold that 886 fib level, and obviously the support levels from the 2017 and 2020 areas. We will move on. I did want to look at a bigger chart, and it actually uses that pi range we had in April, May, June of that kind of 28 to 38k level. Now, you can kind of see a converging line of resistance here and a converging line of support here. Now we're kind of really close if you look on a 3-day. I think this is a 3-day chart. Yeah, you can look at this on a 1-day, 2-day, 3-day chart. But we are approaching the apex of this kind of converging line of resistance and converging line of support. Now, you can probably expect that as we edge closer and that we are going to break out eventually either side of this. And that's why I mentioned there is a sense of impatience and kind of, you know, people are wondering, are we going to range forever? I don't think so. I think given that we're coming into the next 2 weeks, the back end of October, which is, you know, usually a pretty volatile month, and then adding in what Tony said as well about the next interest rate hike, you know, I think we will see volatility over the next 2 weeks, certainly a lot more than what we've kind of seen the last month or so. I will say that given the macroeconomics, what we've discussed at length kind of on the podcast for all those listeners, with incoming interest rate hikes still to come, and the fact that we are seeing inflation not really come down as much as we'd like, that lower is still more probable than just heading higher. And I still believe that this can come in the form of that age-old bear flag that I've shown a number of times, but I wanted to show it slightly differently in this podcast because I want to see kind of the similarity to the prior one, where you can see we fell out of the bear flag, broke down, we back tested it before actually heading to the current level. And we've had a very, very similar situation here. I want to show you here where you can see we back tested it, came down here, we're in the bear flag, we've come out, we've tested the low, we've come back in, back tested it, and this is where we could actually fall, maybe in the next 2 weeks particularly, if we see a harsh sell-off, like Tony said, after the interest rate hike of 75 basis points, that we see one final sell-off potentially to that key area between maybe 14 to 16k, before we see a run up from there and a bottoming out, say, towards the end of the year, start of 2023, before a run up there. Now, that's not to say that it goes against what we were talking about before, the potential for a midterm rally. I've shown to our members harmonic ideas that suggest that technically, not fundamentally, that we can make 100% bear market rally or midterm rally, and these things are possible. So please keep that in mind, that even though this is more probable, we still have possibilities of seeing a midterm rally or bottoming out before seeing lower. Now, sorry, yeah, but I did just want to bring that up because we've got plans in place for the Trading Academy for obviously both scenarios, which is really good. We'll take a quick look at Ethereum lastly before we pack things up. Ethereum, I just want to show the same chart I showed 2 weeks ago because it is the Trading Academy's main kind of point of confluence with how ETH is heading. We've got a parallel channel that's kind of descending, but we've really been ranging like Bitcoin. But for ETH, it's been at that real strong golden pocket area that I just wanted to reiterate is a really strong kind of support level that was flipped as once resistance. You can see we back tested there. That is the point of control for that exact range there, and we've now flipped that support. You can see multiple times we've kind of just wicked out and kind of held it support. So for now we are trading that golden pocket, and I make a comment here that it would be really bullish to flip this wick here to support. So claiming and that could be, claiming the edge of this parallel descending channel here, and then claiming the support there and breaking out to the upside. That would obviously fall in line with our harmonic idea and our midterm rally ideas, but once again, as I showed a couple of weeks ago in the ETH update, we can fall to the lower side of this parallel channel if we see a capitulation or a breakdown in the market as a result of fundamentals or a huge sell-off. So yeah, sorry, I just show those major level support here, where they come from, how it was flipped, how it's now flipped back to support, and we hold it really well. And then a current look at this on closer price action. You can see how well that's worked and how well that's flipped. But yeah, that's it for today's update, market update and podcast. Does anyone else have anything to add before we head off?
I'll just quickly add that beneath... Oh, sorry.
No, Theo was just saying like, share and comment. Go on, Tony.
Sorry, yeah. I was going to say, yeah, beneath that kind of 17k level, there is a shit ton of liquidations for leverage long trades as well. So it's most likely they're going to take it out before the market does hit at some point. But
I think that's the main sticking point from what we try to show macroeconomically and for crypto is like the probable scenario here is that we head to that area. Like we want people to understand that is the most probable scenario, but it doesn't mean it's definitely going to happen. And that's why you need to plan accordingly with your investments for both. That's where the power of dollar cost averaging comes in and whatnot. So you can set yourself up to be prepared for both scenarios. But yeah, great podcast today, guys. Appreciate all our listeners every week. And yeah, we hope you enjoyed, and we'll see you next week. I think next week we'll be going back to the deep dive. I hope everyone enjoyed our Cadena one last week. That was a bit different. We'll be looking to do the same thing next week, and I think we'll be looking at some more decentralized finance stuff. We might briefly go over the course that we're looking to bring out, and we might have another guest on too that's to do with that. So yeah, look forward to that, and thanks everyone for listening.